For the last 30 years, there's been this quiet financial engine in Japan just humming along, powering markets all over the world. But very recently, that engine didn't just sputter, it seized. And now the shockwaves could be heading right for us here in India. So in this explainer, we're going to break down exactly what is going on and why it is so important for every investor to understand this shift.
I mean, look at this headline from Business Today. It really says it all, doesn't it? Japan just blew up a 30-year money machine. For decades, this incredible flow of super cheap money from Japan has been fueling investments everywhere. And now, that machine is broken. We need to figure out what this thing even was, why it just blew up, and what that means for your money in India.
So let's get right into it. What exactly was this 30-year money machine? How did it work? And why is its breakdown causing such a panic in global finance?
Okay, the whole thing is built on this one core idea called the yen carry trade. It sounds complicated, but the logic is actually super simple. For decades, interest rates in Japan were basically zero. That made it incredibly cheap to borrow Japanese yen. So big investors all around the world would borrow massive amounts of yen and then turn around and invest that cash in places with much higher returns, places like India or the US stock market. Japan basically became the world's ATM for cheap money.
And then, bam, on November 19th, everything changed. We went from a world where borrowing money in Japan cost you next to nothing to a new reality where the rate suddenly spiked to around 2.8%. That's the highest it's been in 3 decades. Now, this wasn't just some tiny tweak. Oh no, this was a massive signal that the whole era of cheap yen forever was officially over. So, the big question is, why? Why now? After 30 years of the same old story, what made Japan suddenly decide to flip the switch? Well, it wasn't just one thing. It was actually a powerful mix of forces that all came to a head at the same time.
It really boils down to these 3 things hitting all at once. First, inflation. You know, the very thing Japan had been trying to create for years, well, it finally showed up, but it came in a little too hot. Second, there were growing fears about the government's absolutely massive pile of debt. And third, a really simple one. Investors just lost faith that Japan could keep interest rates at zero forever.
So let's talk about that first one, inflation. For the first time in a quarter of a century, inflation in Japan shot past 2.5%. But here's the problem. People's wages weren't going up nearly as fast. That means their money just wasn't going as far, creating real pain at home. The Bank of Japan simply couldn't ignore it anymore, and now everyone expects them to keep raising rates to cool things off.
Right at the same time, the government announces this huge new spending package. We're talking over 21 trillion yen. Now, you have to remember, Japan already has a mountain of public debt. It's 2.5 times the size of its entire economy. Think about that. So investors looked at this new spending, looked at the old debt, and started getting really nervous. They began demanding higher interest rates to pay them for the growing risk of lending money to the government. Okay, so you've got inflation and debt fears brewing inside Japan. But the story doesn't stop there. This is where a domestic problem explodes into a global funding shock. And it all comes back to that carry trade we were talking about. Just look at the new math for these global investors. The old trade was a no-brainer. Borrow yen for almost nothing, invest it somewhere else, and pocket the difference. Easy money. But in this new reality, borrowing at over 2.8% absolutely kills that profit margin. The whole strategy just doesn't work anymore. In fact, it could even start losing you a lot of money, fast. So what happens when a trade this massive just stops working overnight? Well, investors have to scramble to unwind it. That means they have to sell their overseas assets, we're talking US stocks, Indian bonds, you name it, to get the cash to pay back those yen loans. All that selling puts downward pressure on markets everywhere. And at the same time, some of that money might actually flow back into Japanese bonds, which suddenly look a lot more attractive. The bottom line? You get way more volatility everywhere. Stocks, bonds, even crypto.
All right, let's bring this whole story home. We've looked at the global picture, but what does this funding shock actually mean for us right here in India?
See, India has always been a top destination for that yen carry trade, thanks to our strong growth and higher interest rates. So when it unwinds, we could feel it in a few key ways. We could see foreign institutional investors, the big overseas funds, pulling money out of our stock markets. That selling could put a lot of pressure on the rupee. Borrowing costs could go up for Indian companies, and overall, you can expect more choppiness and risk in the Nifty, the Sensex, and our bond markets. This puts the Reserve Bank of India in a really tough spot.
What's it going to do? The RBI has to juggle managing the rupee, keeping inflation in check, and supporting economic growth, all while the entire global financial system is shifting under its feet. Japan's move doesn't exactly force the RBI to do anything, but it sure makes their job a whole lot harder.
But, and this is a really important point, it is not all doom and gloom. India has a secret weapon that a lot of other emerging markets don't, a super strong domestic investor base. All of our SIPs, our mutual funds, and our retail investors, you, provide this crucial cushion that can absorb some of the shock when foreign money heads for the exits.
So let's wrap this up by looking ahead. Instead of just getting stressed out by the headlines, let's talk about what you should actually be paying attention to over the next few months to see how this whole story plays out.
Okay, here's your watch list. First, keep an eye on Japan's 10-year bond yields. Does that 2.8% number hold, or does it keep climbing past 3%? Second, watch the Bank of Japan's meetings. Are they talking about more hikes, or are they getting cold feet? Third, watch global risk assets. Think about places like US tech stocks that loved all that cheap money. And of course, watch our own numbers here in India, FII flows, and the direction of the rupee.
So, no matter what happens next, the big takeaway is crystal clear. If you remember one thing from all of this, let it be this. The era of permanently free money from Japan is over. Markets everywhere are now waking up to a brand new reality. And that leaves us with the million-dollar question, doesn't it? Is this the first tremor of a coming global debt crisis as this massive fire hose of cheap money gets turned off? Or is this just a long overdue return to normal for Japan, something the world's markets will eventually get used to? Well, the next few months are going to tell the tale.